Say that a man named Zero has just bought himself a brand new boat. This boat is essential to his job of fishing, but sometimes he has some close calls and is worried that he'll eventually total the boat one day. So he goes to a company called Leaf Insurance that offers insurance for his boat. Basically, Zero pays a subscription of emeralds to Leaf Insurance, let's say about 20 emeralds a month. This monthly payment is called a premium. In return, Leaf Insurance guarantees that if Zero were to crash his boat, they will pay the majority of the cost of repairs for him. This pretty much means that instead of Zero having to risk paying something like 500 emeralds to repair his boat all of a sudden, he spreads out his risk and pays 20 emeralds per month just in case something like this happens. At its core, Zero is moving the risk to the insurance company. Now let's say that Zero does actually crash his boat. No. So now that Zero's boat is clearly in shambles, he can now file a claim to Leaf Insurance to cover his repairs. But there is still a cost that Zero must pay before Leaf Insurance agrees to cover it. This is called a deductible. This cost is usually an amount that Zero will know when he signs with Leaf Insurance. Now the deductible cost and the premium cost usually have an inverse relationship. For any insurance company, a higher deductible usually means a lower premium, and the other way around is true as well. These costs exist so that insurance companies get some amount of compensation. Now when Zero pays the deductible, Leaf Insurance will pay the rest of the repairs for him, reducing the potential financial loss significantly. Instead of Zero suddenly paying 500 emeralds, Zero only pays a deductible of 40 emeralds and Leaf Insurance covers the rest. So due to the extremely useful nature of reducing risk with insurance, there's a ton of different types of insurances around the world. Some super common ones you might know about are car insurance for when your car crashes and needs repairs, health insurance for when you're sick and you need extra care, and also there's some weirder ones too. If you know the soccer player Messi, he actually has an insurance on his left leg just in case he loses the ability to play soccer with it. Another one is like alien abduction insurance. Like, what? What is that? Moving on though, let's put on the business spyglass and look through the perspective of Leaf Insurance and explore how their business model works. Leaf Insurance makes emeralds from the premiums that people like Zero pay, but when Zero eventually does crash his boat, they take the brunt of the repair cost, losing a lot of emeralds. This means that in order for an insurance company to make a profit, Zero must not get into a crash for longer than how much the insurance company would pay for a repair. So in essence, Leaf Insurance earns a profit on safe boat drivers who can avoid crashes, while they lose money on reckless ones. This is why Leaf Insurance will always check the records and history of the person they are about to insure to decide on the rates. Let's say that Mr. Villager here is a very safe boat driver. He's going to pay less monthly because Leaf Insurance doesn't have to worry as much about paying for his repairs. Now let's look at Zero. He's already crashed his boat once, so he's more of a reckless driver, and will likely have to pay more emeralds per month to make up for the increased risk. We can see this in something like health insurance as well. Let's picture one more company called Menders Insured. Menders Insured gain a profit from those who don't get sick often, like younger, more fit people, while losing emeralds on those who do, like the elderly and people who already have pre-existing conditions. This means that Menders Insured actually don't want to give health insurance to these kind of people, despite that being the group that needs it the most. This especially has been a hot point of contention for a while now, and many different laws and acts have been passed to keep healthcare away from becoming too inaccessible. But in general, a higher risk still means higher premiums. So overall though, insurance is still an extremely useful thing to have. And it gives you that peace of mind since you know that a catastrophic accident won't lead to financial ruin. You probably already have some insurance coverage of any kind right now anyways, so hopefully you learned something new about how it works. Now if you don't mind me, I have to go fix my car over here, so let me just try to...